I think this issue is actually one of the biggest traps in our past consumption investment practices. If such a formula existed, we wouldn't have all collectively fallen into this situation. Such a collective misjudgment. Back then, everyone thought this could be a trillion yuan track, a revolutionary channel, but it turns out that the billions we invested were wrong.
It was wrong.
Yes, right?
Definitely wrong.
Yeah, most likely it was wrong.
Hi, welcome to 商业外讲. I'm Yang Xuan, an editor-in-chief who observes how people keep jumping between different trends. This time, I want to talk to you about the recent boom in Hong Kong-listed consumer stocks. This boom is reflected in two aspects. On one hand, there's the big opening up of Hong Kong IPOs. After a long period of being blocked, many consumer goods companies have gone public this year. Over a dozen have already listed and more are preparing to go public. This serves as a report card for new consumer investments made in the past 7 or 8 years. On the other hand, the stock prices of star consumer stocks have risen dramatically. For example, Mixue's stock price has doubled since its IPO, Mart has risen 3 to 4 times since the beginning of the year, and Laopu Gold has soared an astonishing 13 times. However, today's darlings of the stock market are somewhat misaligned with the companies that were initially chased by the primary market. Many people may have gotten the answers wrong on this report card. On this topic, this episode of 商业外讲 has invited Chang Bin, founding partner of HeyGen Capital, who has been focused on consumer investment for 20 years. So, what was it like when he founded HeyGen Capital? That was precisely the starting point when new consumer investment began to emerge. He has experienced the entire journey, from the budding of new consumer investment to the wave where TMT investors collectively shifted to consumer and chased after traffic, and then to the capital peak in 2021. Then, as confidence waned and people started switching industries, and finally to this year's explosive wave of IPOs in new consumer investment, the full cycle.
Actually, last year and the year before, I was quite confused too, because we felt that suddenly our overall growth was gone. Everyone else told us China's consumer sector wasn't working, that people were quitting, and asked why we were still sticking with it. But after we went back and relearned the secrets of this round, we realized, even when we're facing a market that's no longer growing, to a stock market, we're not that afraid anymore.
We'll start the discussion with this wave of IPOs then, from Chang Bing's perspective, review the full cycle of new consumer investment over the past 8 years, and talk about what he's seen, thought, and learned. In the past year or two, the mood, especially among consumer investors, has had ups and downs. For a long time before, people said consumer stocks weren't encouraged to go public, so everyone was stuck, unable to get listed. But this year, there's been a breakout. Not only are companies going public one after another, but their stock performance has been excellent, and the rate of IPOs falling below their issue price has dropped a lot, right?
It's true. I should say that since this year's Spring Festival, not just consumer investors, but the entire consumer sector has been in much better spirits. About a month ago, I went to Hong Kong for this. This kind of event is held once or twice a year, and in the capital circle, you can really feel the difference. The atmosphere is much warmer than it was in the past 2 years.
So, are people smiling more or what?
Of course. I remember that day, the keynote speaker was the CEO of the Hong Kong Stock Exchange, a woman named Bonnie, if I recall correctly. She said the highest compliment people give her is calling her the biggest salesperson in Hong Kong. She represents Hong Kong, and Hong Kong's stock market has also gone through a downturn over the past 2 or 3 years. If you look at Hong Kong's stock market this year, it's once again leading the world in terms of IPOs and capital raising. It's ranked number 1, attracting the attention and enthusiasm of global investors. The consumer sector is probably the hottest segment among them. It's only been half a year so far, and there have already been about 14 or 15 consumer companies going public. Second, I remember in 2023, there were 6 companies, and among them, we invested in 2 that year. If you look at the current queue, we've roughly estimated with these investment banks that just in the consumer sector alone, there are probably about 100 to 200 companies eager and waiting to submit their prospectuses.
Take HeyGen flavoring and food, for example. Not long ago, they raised funds far in excess of their target multiple times. And this year, some consumer stocks have surged incredibly, like Laopu Gold. With consumer stocks being so hot and valuation so high, would you say this is the result of the company's own efforts? Or is it more about market sentiment driving things behind the scenes?
I think there's a saying, right? Of course, individual effort matters, but the broader trends of the times are also extremely important. First of all, I believe the government has provided a lot of policy guidance and support, which can't be denied. As everyone knows, in recent years, China's capital market has had clear directions and preferences. And when it comes to the consumer sector, it's actually not one of the highest priority sectors in the A-share market.
Technologies don't prioritize, right?
Yes, actually, over the past year, there have been a lot of conveniences provided for consumer companies to go public in the Hong Kong stock market. Secondly, I think especially this year, with everyone paying attention to the so-called deep sake moment and the geopolitical factors leading to a revaluation of this group of Chinese companies, a revaluation of the value of Chinese companies, global capital is once again reassessing Chinese assets. Because honestly, the past 2 years have been really tough for us. Jokingly, we used to say that we weren't even valued at a reasonable level. We were valued like non-performing assets. More importantly, and I think this is the most crucial point, this wave of companies has truly brought out the strongest lineup from China's consumer sector in recent years, right? We're talking about companies with profits in the billions, right? Growth is either revenue growth, like Mart, which has had nearly double-digit extraordinary growth year after year, or it's profit growth, like Laopu, and they've also achieved such a massive scale. Take Mixue, for example. They sell drinks for just 5 or 6 yuan a cup, yet in the end, they're able to generate 4 or 5 billion yuan in profit. People are actually quite surprised by this. It's really exceeded everyone's expectations. Moreover, when these companies with such outstanding performance eventually went public, they were actually very generous at the time of their IPO. In fact, the IPO price was quite reasonable, and the market conditions were very favorable. Even for such outstanding companies, their IPOs might have been priced at around 10 times this year's earnings or just a bit more, which allowed for continued outperformance in the following periods. As a result, the market saw significant profit opportunities, and this was a key factor. So when this profit effect took off, the entire market gave them even more attention, and after this flywheel effect was created, things really took off. Then, driven by them, a group of high-quality companies like these emerged, which brought the consumer sector into the spotlight first.
From what I recall, the previous chairman, like Li Xiaojia, brought the last batch of companies, like Meituan and other key internet firms, to the Hong Kong Stock Exchange. So, for the current chairman, is his main achievement bringing companies over or attracting capital?
Indeed, at that time, I think the previous chairman benefited from the fact that global capital had clear expectations and confidence in China. But over the past few years, global investors have started to question whether China is still worth investing in and whether it remains investable. If in the past the goal was to bring in more good companies for these investors who were waiting, today the situation is different. We still have a great many excellent companies, and their valuations are very reasonable. What's important now is that I need to attract global capital and tell them it's worth taking a closer look and reconsidering investing in Chinese assets.
What advice do you give your portfolio companies? Everyone knows if you can list on the A-share market, you should. A-share prices, listing valuations, and multiples are high. For example, look at Insta360, which just went public. That valuation, right? But going to the Hong Kong market offers more certainty, though the valuation may not be as high.
If certain specific conditions are met, I would recommend that everyone still actively pursue this direction. As for those conditions, I think first, many still need to have solid financial performance. And within that, the weight of profit performance is especially high. In our view, if a company can generate around 300 million in realized profit over the past couple of years, and then has an expected profit of around 500 million, I think they should actively try for it. And if on top of that, you can add that in your specific market niche, you have more unique characteristics, a good market share, a fast growth rate, and strong product innovation. When you have features like these, you get an even bigger advantage. So for those that meet these kinds of standards, we still suggest that you might as well get the work done first and then get your prospectus out there. To actually be able to go through the whole process, overcoming the various obstacles, getting approvals, passing regulatory reviews, and finally finding the right investors to set a price and list, I estimate you'll still go through a lot of changes and challenges. So we still encourage everyone to get this work done in advance and have the courage to take that step.
You just mentioned that secondary market investors might come and ask you about cases like Nayuki's tea. What indicators do they care about? What is it that the market is really concerned with?
To be honest, at the beginning of this wave, people were buying for a very, very simple reason. It was cheap.
Oh,
right?
A low PE ratio.
Yes. In fact, today, for companies going public in Hong Kong, why do some have excess returns? There might be 5 or 6 milk tea and coffee companies all going public at the same time. Now, is it really the case that for every one of these tea companies, my future growth potential, my growth rate, and my profit margin are all the same? Of course not, right? But when they go public, it seems like everyone is treated about the same. They're all getting a 15 times multiple, right? Or maybe 10 to 15 times. Between Haiti and Guming, what's really the difference? One of them might have opened 8,000 to 9,000 stores in just a few nearby provinces. The other might have used the entire country, maybe over 20 provinces, to open 8,000 to 9,000 stores, approaching 10,000. So which one, when we buy stocks, we're buying the future, right? So in 3 to 5 years, which model will be better? More and more investors have to keep digging deeper and asking, who is going to be the faster horse, right? Who, given their current price, is likely to create more long-term value for me?
Right. Yes, exactly. I get it. It's like you're saying the multiples they're issued at are all pretty similar, but within that, depending on the company's fundamentals and its corporate governance, their future growth potential can be vastly different. So there's a huge opportunity to find a bargain.
Yes.
If you ask me who I'm bullish on Mixue, but I feel like the whole market is bullish on it and the price has already gone up.
Yeah, that's the thing about everyone being bullish. With consumer stocks, sometimes you can see it clearly, but you might not make money. That's because if everyone sees it, it's probably already reflected in the price.
For example, when Pop Mart went public, it was really hot. I remember at the time, the people I knew in the primary market, and everyone was saying, wow, Pop Mart is amazing, because it's like an addictive product and so on. And I remember many of them personally went to subscribe to the Hong Kong IPO. And then, but later, Pop Mart's price didn't hit rock bottom. It stayed at the bottom for a very long time. And it seems a lot of my friends didn't manage to hold on.
Yes.
Why is that? I feel I understand it well, but in the secondary market, I might not have held on.
Looking at its revenue, profit, its growth rate, and its valuation, that's one level of understanding. Then maybe I understand its core products, the mechanics, why it got popular at this particular time, and why it might not be as popular later, and when the next big thing will be. That's a bit better. But an even deeper understanding is knowing what the long-term core growth drivers are in this business and what structural growth opportunities exist.
So, do you have a prediction for how long this window of opportunity might last? Or what advice do you have for the companies you've invested in? Should they be rushing to seize this window, or is it better to not be in a hurry and take things slowly?
If a company wants to present 3 years of financial results, it means that the preceding years would have to cover the challenges of the pandemic, the macroeconomic headwinds of the past 2 years, geopolitical pressures, and all sorts of other uncertainties. If I want to file a prospectus in 2025, it means our companies need to make the most of these recent years. Even if these past few years have been very challenging, if we still have a group of companies that can deliver strong results, then those are the companies that have really been put to the test, right? In the past couple of years, people might have come to us and said, hey, just like our investors ask us, look, consumer companies can't go public, so what are you going to do? Does that mean we should also go ask the entrepreneurs, look, you've done so well, but you can't go public?
At that time, what can you do?
Right? They'd say, what can I do? Right? I'll just keep working hard. I'll just focus on building the business. If you ask me about that, I can't solve it either.
At that time, the market sentiment was very down because the secondary market sentiment would spread to the primary market. They'd all say, oh, you can't go public in the consumer sector. And that was actually a challenge for fundraising in the primary market as well.
Yes. If we look back at the last couple of years, The most direct feeling is that our consumer investments, say in the primary market, compared to the heat of 2020 and 2021, it's like night and day, right? Most funds that used to cover multiple sectors have, to varying degrees, reduced their allocation to consumer investments. Many have even removed the consumer sector from their investment scope entirely, right? But for us, we were in the thick of it and we were still willing to stick to our guns to keep going. We decided to focus only on consumer and even more so to focus on domestic consumption because sometimes the cycles change too quickly. If you're just chasing the hot new thing,
right,
you're actually worse off than if you had just stayed put. I sometimes joke internally, perhaps even quietly to myself, that the reason we survived this cycle of consumer investment, and we've been through a 7 or 8 year cycle, the reason we're still standing has a lot to do with our initial perspective on this very point. Let me give you an example. We're a consumer fund founded by people with a background from JD.com. And you can imagine the time we started was precisely when various retail formats, especially online formats, were at their hottest. In high tier cities, you had dark stores. In lower tier cities, you had community group buying. In this space, across the entire market, I'm sure relevant investors poured in tens of billions, maybe even hundreds of billions of US dollars. And then if you add in giants like Meituan and Pinduoduo, the cumulative investment was definitely in the hundreds of billions. But as for our fund, we didn't invest a single penny in that direction. On the contrary, over the past few years, we were probably the most active and determined investors in offline retail formats. So that's where, at that point in time, drawing on our prior understanding of retail, especially our insights on the supply side and the supply chain, we actually made some judgments that were quite different from the market at the time.
Here's an example.
The biggest example is, well, just recently, let's take community group buying as a case in point. After everyone invested and had such high hopes, today Meituan has basically announced that it's making substantial adjustments to its Yuxuan business, right? Which means that back then, everyone thought this was a $1 trillion track, a revolutionary channel, and the hundreds of billions that everyone threw at it was a mistake.
A mistake?
That's right, isn't it?
A definite mistake.
Yes, it was very likely a mistake. And with dark stores, some companies have survived. Companies like Ding Dong and Poo Poo, at revenues of tens of billions, they can make it work. But today, everyone sees the limits. It might only work for the convenience needs of wealthier users in high-tier cities. It's not a universally applicable model for the whole country. And from the perspective of these companies' market caps relative to the return on the capital they've spent, I think it will still take a very long time for them to earn back the money they burned through.
It's hard.
That's right. On the contrary, we were already starting to see things from a different perspective. We saw that in these cities, a redesigned offline business format could actually be the most efficient. So from 2016, 2017, when we started investing, we were the first to propose a concept called community chains, which we later upgraded to community 10,000 store chains. In 2017, we invested.
Can I understand it this way? You're saying that for these retail systems, if you use online delivery, the cost and revenues just don't add up. It's actually more suitable to open physical stores.
That's right.
Could you elaborate?
Let me explain with a simple example. In China, we all know about going to the supermarket for fast-moving consumer goods. From when they leave the manufacturer to when they're priced for consumers, the price usually doubles or triples. Basically 2 to 3 times. I'll give you a very simple, everyone knows a bottle of Nongfu spring water is 2 yuan, right? But if you look at Nongfu Spring's financial reports, the cost recorded is only 80 cents, and they still have a gross margin of over 60%. This means for the 2 yuan water you drink, in reality, the contents are probably only worth 30 or 40 cents. So where does the difference between 80 cents and 2 yuan go? A large part of it is in the process. In traditional offline distribution, you need distributors, wholesalers, service providers, and retailers. You have to account for this fee and that fee. Then there's a 90-day payment term before the manufacturer gets paid. So all that money in between becomes these intermediary costs, distribution costs.
Right, distribution costs.
But today, if we look at what we have, like Mingming Henmang or Lingxi Henmang in the beginning, Yanzhou, Mr. Yan, he innovated on this. He said, what if I go find the brands today or get a whole batch directly and I don't charge any fees. I just use cash. Now, why can I do this? It's because I have enough confidence in the operational efficiency of my business format today. Because I know that when I present a price that's 60 to 70% of the original to the consumer, when I present such a beautiful, tidy, and pleasant retail space to everyone, this open shelf, self-service, bulk weighing format for everyone, and I also open it right in everyone's neighborhood, then people will just love me. In a residential community with maybe 2,000 or 3,000 households, every day there will be 500 customers coming to my store, and they'll come 3 times a week. Maybe the person next door, renting a space the same size as mine, opened a convenience store, and their daily revenue might be 3,000 to 4,000 yuan. But if I open a store like mine, I can do 15,000 yuan a day.
Wow.
Yes.
So that means its store format and the products within that format are actually also optimized extremely well?
Essentially, we have greatly innovated the retail product itself and at the same time have also drastically improved the overall efficiency of our supply chain. That is exactly why we are able to offer consumers both consistently low prices and a truly excellent experience. And in addition to this, we have also made the entire distribution process significantly more efficient. Internally, we have for the past few years, we've actually had a judgment, and it's become clearer now. If we say that for the past 10 plus years, much of China's retail has been driven primarily by online channels. In fact, back in 2020, we had a pretty clear conviction that I think going forward, offline would gradually become the main driver of profit. Mixue Bingcheng, today, everyone finally knows how powerful it is and profitable it is. If we turn the clock back 3 years, I believe not many people were paying special attention to this company. It's definitely...
You're saying HeyTea dominates the new consumer market.
Right. It's definitely not everyone's darling in this space. People might think at this price point, back then, people were even asking why it was a franchise chain and not just a scheme to exploit its franchisees. And then, quietly, the chain store model in China has actually undergone a massive qualitative change and leap forward in recent years. We already have many brands with several thousand stores. This kind of chain, brands with 1,000 stores, has become very commonplace. In shopping malls, brands like ours with over 500 stores have also become very numerous. More importantly now, our offline formats, the ones we used to think were challenged and lagging, like supermarkets, are now starting to be revamped. In the past 2 years, everyone finally realized that after all the fuss with new consumption, you guys weren't using online methods to improve Mart or Yonghui. In the end, it's a guy named Donglai Gay from Shuchang, Henan, who is teaching all of us how to reinvent the supermarket, right? And also,
Sam is teaching everyone how to reinvent themselves.
Sam is teaching everyone how to make good products, and Donglai is teaching everyone at home how to create a successful retail format. So I think today our offline sector has reached a stage of substantial change, improvement, and leadership. Moving forward, I believe online and offline will become deeply integrated. At this point, it's clear that in the past 2 years, these online channels, the marginal price is rising. What about offline in the past 2 years? Mainly it's due to our housing prices, which is the main reason. In these 2 years, housing prices have kept declining and rents have also dropped. More importantly, our operational efficiency improved. So offline stores are seeing a shift in fortunes. So the highly efficient empowerment system formed by our retail chains today, just think about it. In the past few years, the milk tea category alone has definitely opened over 100,000 chain stores, and the snack sector has certainly opened 30,000 to 50,000 stores, and it's still growing rapidly. So the true scale and chain development in China, its advantages are only just beginning to show at this moment.
Oh, so when everyone was concentrating all their attention on the online traffic dividends, huge changes were actually happening offline.
Yes, I think the changes happening offline today might be even greater than what people realize. Even now, our understanding is still lagging behind the reality. in the past few years in China, it wasn't just the online infrastructure is world leading. In fact, our offline infrastructure has also quietly become, in my opinion, one of the most efficient systems in the world over the past few years. Of course, we are still in the process of continuous evolution. So at this point, you'll notice in the past, reaching 1 billion or 2 to 3 billion in scale might have taken 10 or 20 years. Even in the era of e-commerce, when we had JD.com and Tmall, it might still have taken 5 or 10 years. But today, this time frame could become 3 to 5 years, right? So we see that many of the people we just talked about, those who are able to submit prospectuses to the Hong Kong Stock Exchange, for example, Lin Qingxuan, a company we invested in, behind their success, they all seized this kind of opportunity. And more importantly, as we just mentioned, they don't just focus on one side. Take these companies, for example, in the beginning, like Lin Qingxuan, they had 500 offline stores. It was precisely because they didn't jump into the e-commerce era too early that if he had entered e-commerce too early, he would have had to compete by selling at low prices, and the brand might have gone downhill as a result. Frankly speaking, if we only talk about traffic and say we only operate online, if we only rely on traffic to grow quickly and get big, you won't be able to hold your ground in the middle stage. But once you're willing to move offline and make long-term investments, when you have physical stores, that's when you truly have your own private domain. You can directly serve your consumers as a brand, and your pricing can finally stabilize here. Online, you can sell some super popular products, but here you can fully expand your product range and start having more interactions with consumers. For example, when consumers buy Lin Qingxuan online for travel, they know that they think, oh, nourishing the skin with oil is good, camellia is good, and so maybe there's a promotion and I buy it. But when you go offline, someone gives you a great introduction and then they give you a beauty treatment, right? You might immediately feel the difference at that moment. Online, I might buy just for the discount, but here I might end up buying a whole set.
But let's come back and talk about cosmetic brands, because actually we've just talked a lot about offline entry channels. However, if you look at new consumer investments, looking back now, perhaps the hottest categories used to be cosmetics and beauty products, right? There have been countless dramatic stories of financing and going public in this space. For example, we used to write complete diaries about Perfect Diary and did in-depth reviews of how much money they raised from investors. But in the end, when we look at Perfect Diary's performance after going public, right, I think it's probably very hard for them to break even. So for investors now, when we look back at this, when new consumer brands were at their hottest in the beauty industry, what kind of companies and what core capabilities allowed them to stand out? If we set aside the TMT sector and look at it, is it the same as the traditional investment logic back in the day?
It's not exactly the same thing, but now that we look back, we also realize that if we don't understand the old ways, it doesn't work either. Because the logic is simple. Back then, when we all invested together in beauty and related sectors, we were really after two things. First, can this area produce new products that grow quickly, right? So everyone bet on it, thinking there was change happening here. That's why when it comes to so-called TMT investments, I love investing in change the most, because it's about doing something new, which means you can move fast and scale up quickly. So everything in the first half was absolutely right. But the problem is, if we look back today, its strengths might also be its weaknesses at the same time. Why was it that back then we had so many cosmetics brands and could launch so many products so quickly? Because upstream, there were some large-scale suppliers providing solutions for everyone. Our companies themselves weren't actually doing product R&D. We only made some minor differentiation in product design and did positioning and planning in marketing.
So the product barriers were very thin.
Extremely thin. In the process, we only did some very basic things with the products.
Right?
And then, going back, we also didn't do any manufacturing or processing ourselves. We relied on an open supply chain, and we also used open channels. Everyone had to go to Lijaki. Everyone had to go to Via. Everyone has to go to short video platforms. So every part of the process today is open. There's not a single area that's exclusive to you. And everyone is a new brand, so no one is really more efficient than anyone else. So the advantage is that because everything is open, I can jump in right away. If 100 companies want to enter, that's not a problem. But the flip side is, since nothing is exclusive, you can't keep others out either. So in this industry, competition can't be eliminated or pushed out.
Right. Isn't this what people often talk about when they mention the word brand? It sounds simple, just two characters, but there's actually a lot of meaning behind it.
On the contrary, I actually think brand might be the last barrier to be formed.
Is it a result?
Right, but I think at that time, whoever could first get a unique product, my product might be different from others, right? Whose channel structure is different from everyone else's. If everyone is just saying, I'm going all out to find super investors, or I'm focusing on Xiaohongshu, if there's nothing different anywhere, that means you actually have no barriers. In the end, as we keep doing this, I believe we will ultimately need some barriers. These differences are what truly ensure that what you expand today can actually be protected by you. So looking back today, when we review our investments in some of the popular categories at the time, it was just that we started with good categories. But in the end, it might turn out that a category which seemed bad at first actually has very high financial barriers, and not many people are doing it. In the end, after working on it, it might actually become a pretty good segment. For example, among the companies we've always invested in, there's one that really exceeded our expectations. It's called Yuanxi Furniture.
I remember when we were studying cosmetics at the time, everyone had a small observation, which was that beauty products are especially suited to being showcased in front of the camera. However, people's understanding or acceptance of this might be focused on certain aspects. Not so much in the more obvious categories like foundation and skincare products. This might be one perspective. But if we look back today, take a brand like Mao Geping, for example. They also do beauty products, and they do it very well, right? So now, looking back in the beauty, cosmetics, and skincare sector, if you look at it in retrospect, how does its uniqueness stand out?
First of all, before our current wave, they already had this going for them.
Brought masters.
They had masters, and even today, their products are overall of high quality, plus they have this established positioning in history. So from this perspective, in the long run, they can outperform the whole market over time. They have an advantage.
Their personal brand established itself first.
Yes, for example, in beauty, there's also Proya. So actually, this is how it works. The previous generation of brands back in their time were distribution-oriented brands. Their products might have been average, but their positioning was always high-end. As a result, they happened to catch the wave of the Douyin era. So when they started doing skincare, they weren't actually selling the original products anymore. They changed them. The quality is similar to that of new brands, but I've added my legacy brand on top of that. So in the same marketing environment, I have more pricing power than you, and my conversion rate remains consistently higher. So you'll notice that it's actually these historically established companies with accumulated experience that ultimately secure a ticket to the mid-tier in industries that seem to have low barriers to entry. For example, Proya has pretty much achieved this. In fact, sales in the billions are really just driven by a few key products like the early C and late C, right? Unlike new companies where I'm constantly talking about all sorts of flashy concepts for products, these established brands may only need a few solid, reliable items. Then, by leveraging the brand momentum built up over the years and some organizational innovations, they may have already captured the majority of the market. It's not necessarily the innovators, the first to innovate, who are destined to take it all. On the contrary, even if we are latecomers today, if they still possess some core capabilities, right? They still do. Today, they have brand, R&D, production, and supply chain capabilities. These are still present. In the marathon of category competition, these are the decisive factors. Going further, I actually think that today, much of China's skincare industry is still driven by marketing. But if we look ahead 5 or 10 years, I believe it will be more driven by efficacy. At that point, everything will require deeper, more scientific research into ingredients or mechanisms to provide support. For example, in Japan or in many other skincare categories, in the end, it's all about technology-driven products. Brands fundamentally establish themselves on this, right? For example, not long ago, there was a huge stir over whether Giant Biogene actually had real technology or not. So we can see a trend emerging for what's coming next. Brands may need to have more solid technological support at their core.
That's right. That's a great summary. I've also heard people discuss before that, for example, in the beauty and skincare industry, or when it comes to why certain brands have risen recently, a very important factor is the technology or product itself. In fact, in recent years, there haven't been any major breakthroughs or iterations, the old formulas actually. It's relatively easy to copy, so it's unlikely to create. It's unlikely to have a disruptive technological gap like leading companies such as L'Oreal, who can introduce a breakthrough technology that others can't catch up with. Here, everyone can catch up. The products are similar, the effects are similar, and I'm cheaper than you. It's still very easy for people to pay for it, but you never know. What if they suddenly make a technological breakthrough? Right, because I've also visited L'Oreal's global R&D headquarters, and they really do serious scientific research. Although I can't say exactly how much of it is genuine research, they do have a proper R&D department. For example, with this wave of new consumer investments, it probably started to rise around 2017 or 2018, and as I recall, by 2021, there was a lot of money in the capital market, and things were especially hot. For example, now when we look back in hindsight, when we look at that particularly hot period, because you personally experienced every moment of it, do you still have any vivid impressions of that time? Looking back now, how do you feel about it?
You'll notice that a lot of people were standing guard on high poles, right? Let me share a very concrete scene. Not long ago, I started another company. This was in 2021 when we started it together. Before I went to meet him, I opened up the BP and interview notes from back then. He said he wanted to create a retail business model. He said, I want to do some imported goods. I want to develop some private label products. I want to do this and that. And how can I have a price advantage? And so on. This time when I visited, I was surprised to find that he had actually accomplished everything he talked about. But then when I compared it to back then, I realized something. Back then, he said, we're just getting started this year. The market is huge. It's growing rapidly. This year, we might open about 100 stores. And then in the following years, we'll open 200 to 300 stores annually. So for example, in about 3 years, we could reach 1,000 stores. As it turned out, they really had opened 200 or 300 locations, just as they said. But instead of reaching that number in a single year as planned, it happened like this. Maybe this year in a certain region, they opened these locations. Then they realized they needed to reassess their understanding of the business. Going forward, they might proceed more steadily and cautiously. They also found there are some limitations to their site selection and boundaries to how much they can win. So over the past couple of years, maybe having 300 or 400 stores is actually a more reasonable midterm goal for me. If you ask what has changed the most, I think the biggest change is in expectations.
Expectations?
What's changed is the level that everyone thinks can be reached. That's the biggest difference compared to before.
Back then, confidence was high.
Yeah, so if people had those kinds of expectations back then, you can imagine that everyone would definitely, I would want to stockpile more resources, make more investments, and then, well, if you want to raise that much money, the valuation would definitely be sky high, right? But if you actually invested like that today, you'd find that a lot of the money would end up being wasted and useless.
I remember recently talking with a few founders of consumer companies, and they all mentioned one thing. They finally did the math and realized that some of the stores they had invested in before, the numbers just didn't add up. For example, at the time, they secured a really good location, the space was huge, and the renovation, right, felt like they spent a ton of money. But in the end, they realized, hey, if you look at each individual store, maybe the space needs to be reduced, maybe the location needs to be changed, maybe the foot traffic just isn't there, so maybe we need to close this one. When you break down the numbers for each store, there are actually a lot of areas that can be optimized.
That's right.
The business model isn't fundamentally unworkable, but there are many adjustments needed along the way.
Yeah, so at that point, I think both the founders and the investors, because at that point in time, it was the starting point of innovation and a period of high activity. Most people were making linear projections based on the opportunities and the external environment. But at that time, I probably couldn't accurately predict what kind of capabilities would actually be required. Right? What exactly do I need to spend in the process? Because we needed to build up to 100,000 and everyone was just starting to try things out. But after going through that round, I believe everyone came away with a very practical principle, which is that we now know where our boundaries are, where the ceiling is and what the limiting factors are. So it has to be said that in that era, both founders and investors paid a huge price together in this process of exploration.
Actually, you've talked about your investment philosophy before. Let me read it out. First, it's about fundamental product tracks that are high frequency and essential needs. That's the first point. The second is having a unique solution. The third is a twofold growth rate. Regarding this set of criteria you mentioned, have there been any iterations? For example, looking back now, which ones do you feel have been validated and which ones make you think, maybe I was a bit too simplistic back then and I've evolved since?
Actually, in recent years, I've learned a great deal throughout the process. However, I still feel that the directional choices we made at the time were quite suitable for us. Indeed, from my own perspective. My educational background, right? I was involved in financial capital with Mr. Xu and then at JD.com. We really preferred, compared to the consumer innovation options available to us at the time, those categories that were more like essential scientific products because we felt that these industries could be sustained and developed over the long term.
But as I recall, Mr. Xu was still very optimistic about consumption upgrades.
Actually, I think whether it's consumption upgrades or the categories we've chosen, it's all about upgrading products. In any category for our new generation, what we're doing is improving performance and cost effectiveness. The direction is the same. So you'll notice that we might invest in things like Shiudaoqian rice, Yuanxi Muyu furniture, or Shuiji roasted seeds and nuts. Take Shiudaoqian, for example. If you can ultimately become the #1 brand of premium rice in China, I believe you probably won't have to worry much about demand for decades, right?
Chinese won't stop eating rice.
Exactly.
Yeah.
So, for example, when it comes to our bakers at the time, you might say, I created a new mochi product, or today I want to make other kinds of snacks. Compared to things like sunflower seeds, peanuts, or chestnuts, these always seem to have a certain staying power, right?
The question is whether it has enough longevity, right? Behind it, we still hope
that this is a long-lasting business. Even though it might not have explosive growth, the business can be sustained for a long time. Secondly, when we talk about a unique model, it actually means that everyone needs to create new combinations in terms of product, channels, and supply chain. Especially, I think that in this recent wave in China, the real opportunity has been about how to use supply chain efficiency to make better products while also lowering prices. Oh, that's it.
On one hand, the product has to be good, and on the other hand, the price has to be low. Achieving these two goals, or even just one of them, requires a unique solution.
Actually, over the past 2 years, we've gradually started moving from essential categories into optional categories. So coming back to today, for example, has there been any change in the clothing category in China recently? Actually, there have been a lot of changes, right? In the past, our clothing was mainly the biggest differences in clothing. If today offline brands require a markup of 5 to 10 times, the popular brands people like to buy, the down jackets everyone loves. In fact, people are generally paying a premium of about 10 times the cost just because they like them. But today, brands like Yaya only mark up by 2 to 2.5 times, selling down jackets for 299 or 399 yuan, and they might even have Wang Yibo as their spokesperson. There are also some basic items like Camel's outdoor jackets, which are 300 to 400 yuan each. This is how we manage to keep the markup for basic items at around 2 times the cost from the very beginning, because I use Douyin directly, even if I pay a 30% marketing cost. These are still okay for me. In the process, there really isn't that much emotion involved anymore, right? I just know that Camel is a bit like me. I often say, maybe it's like when Uniqlo appeared in Japan. I know it. I know the quality is good, but I don't really expect to get any deeper feelings from it. But maybe beyond this, we see different solutions, right? For example, nowadays, people buy brands like Perstep, Arc'teryx, Descente, and Kailas. Online, my markup is maybe just 2 to 2.5 times. A markup space of about 3 times, but my markup rate is low because I make very good use of it today. Brands that combine online and offline channels might go even further. On top of that, I add emotional value for everyone. I invite brand ambassadors, and I might infuse the spirit of the mountains into my campaigns. I can also do what your brands are doing. I can sponsor Peking University's climbing community to challenge Mount Everest. So from this perspective, the companies that have emerged from our generation, whether it's the products or the premiums charged to consumers, are both lower. But my company is doing just as well. We're performing beautifully. You can take a look and pay attention to the prospectus they've recently submitted. It's just as impressive.
Well, I actually think that maybe it's because China is such a huge country and the consumer groups and their needs are extremely diverse and varied. For example, take outdoor jackets. Recently, my friends around me have all gone to buy Kailas jackets. Kailas is quite expensive, 3,000 to 4,000 yuan for one. Its brand design, the impression the brand itself leaves, and its functionality are all quite good. Also, I think sometimes clothing has a show-off aspect to it. There might be a group of people who don't really care about how cheap something is, but rather care about who they become when they put on that piece of clothing. And then, for example, take this year's hugely popular Laopu Gold. I think the logic behind luxury goods is kind of like this. People now are very aware that Laopu Gold isn't just gold. It's like China's Cartier. People talk about its premium, its pricing, and how it's set according to luxury standards to some extent. Isn't that right? There are still some really outstanding companies that fall outside the investment logic you just mentioned.
Yes, of course. Looking back today, I completely agree with one point. Our Chinese market has a very large vertical gradient. The layers and tiers here are much more diverse than those in the European and American markets, or even compared to today's Japanese and Korean markets. For example, if we look at fast-moving consumer goods like bottled water at the 1 yuan price point, we have purified water, brands like Wahaha, Yibao, and Jinmeilang. At the 2 yuan price point, we have Nongfu Spring, which is marketed as natural water. At the 3 yuan price point, we have mineral water, right? So actually, water is just segmented in such a simple way. But if we look at tea beverages, for example, there are many more layers. So today, to be precise, the Chinese consumer market is becoming a tiered market. That means you need to excel within your own segment first, making sure that your products are well matched to the needs of consumers in that segment. And on top of that, there's the matter of value for money. Once you've met those basic needs, you should do everything you can to elevate the emotional value for the consumer, what we call making the consumer feel like they're getting more. The higher you can raise this, the stronger your brand becomes.
Because when it comes to investment, people still pay a lot of attention to the individuals involved. But I feel that the consumer market is so diverse and varied. So is there really a standard for evaluating people, or is it just too different? If you look at the companies that are doing especially well right now, especially the hot ones listed in Hong Kong, both the companies themselves and their founders are all very different. In other words, there isn't a single unified profile here. Or maybe we can look at this question from the opposite angle. If there isn't a unified profile, is there at least a common pitfall? For example, if a person has certain traits, does that mean there's a high chance things won't work out?
I think that this particular question is actually, in my opinion, one of the biggest and most significant traps that we have encountered in all of our past experience with consumer investment.
Right.
It's almost like we think that there's some kind of universal, formula or method. That can solve everything. Like, if we find this type of product or this type of market segment, starting from Douyin and then expanding to all channels, and if we have this kind of person, maybe today for beauty products, you need someone who used to work at Procter & Gamble or L'Oreal, then this person can make it work. If everyone is facing the same situation, then if this formula really exists, otherwise, we wouldn't all have collectively fallen into this kind of collective misjudgment. On the contrary, what we're seeing is the elements of success in consumer markets actually differ for every specific product and market segment. They might all be different or even discontinuous. Haven't we invested in some popular companies before? Oh, they created a hit product like this beverage. Then they say, oh, it seems you used a consumer-oriented approach. So today, I might be able to multiply this product by 10 directly. That's what I can do. At the time, the founder believed this too. The investors believed it as well, but in the end, we found out otherwise. There is no universal method for this. The actual probability of success in consumer products is much lower than people think. If, when formulating a growth strategy, we just use addition, subtraction, multiplication, and division, these 4 formulas, can we really calculate any business plan we want? Right? Today, I've made my first successful product, so I add another successful product, right? Then, when I have one successful product, I keep adding to it, layering on more channels. Can I start with JD.com and Tmall? Then I want to do Douyin, then Xiaohongshu, then go offline. Offline, I'll start with convenience stores, then move on to distribution. So you see, I'm using one product to connect everything. 5 channels, 5 offline channels, and then if I add another one, in the end, I'm telling you 10 times 10, doesn't that get me to 10 billion? So you see, I'm about to hit 10 billion very soon. Shouldn't you give me some money? I'll be able to reach that point quickly, right? That's why if you look at everyone's business plans, they're all written like this. But in reality, you just can't make that leap. You might be able to do online, like today, maybe with 3 squirrels. They reached 10 billion online very early on, but they still haven't successfully broken into offline channels to truly achieve what I want, to become stronger, last longer, and grow bigger. What you actually need is another way of thinking from the addition, subtraction, multiplication, and division we mentioned earlier. In fact, you need subtraction.
Subtraction and
Division.
start from there.
Exactly. Because, for example, as we mentioned earlier, like when Genki said back then, if I focus on the consumer and develop hit products, then the whole company would end up coming up with dozens or even hundreds of ideas.
Right.
We could all give it a try, I think.
I think they have too many new products.
Yeah, that's right.
Yeah.
But in the end, if you want to get to 500 million, you realize that a lot of them just can't make it. To reach 1 billion, you might need the entire company's effort and maybe even have to take advantage of the pandemic to finally get there. Take Ali Energy, for example, their electrolyte water, right? Maybe it was only in the past couple of years when the timing was right that they finally found this Chinese style, this beverage, right? So now, looking back, I realized that what's most needed in this process is subtraction. I used to want to try 100 things. Maybe I should start by narrowing it down to 10. And there's another way of thinking, which is division.
Oh, could you elaborate on that?
We need to pay more attention to efficiency metrics. That's what I realized with my initial product today. For example, how efficient is a single product, right? How efficient is each of my stores? What about the efficiency of my staff today? How efficient is each individual? How efficient is a single supply chain site? So only by measuring every stage and maximizing these efficiency metrics can we truly excel. Only then can I create greater potential energy and achieve sustained growth. That's why Mixue Bingcheng. In the end, I realized that wasn't the case. In fact, from the very beginning, I had already optimized for efficiency metrics and always did my best. Even though I sell lemonade for just 6 yuan a cup, thanks to the efficiency of my supply chain, I've built my own factories. I've even pushed lemons all the way up to the source, sought out the ranches myself, and driven down the price of milk right at the origin, minimizing costs at my factories. So today, by pushing efficiency to the extreme in every aspect, supply chain efficiency, store efficiency, and the efficiency of each cup produced, only when efficiency is maximized can I ensure that my expansion will accelerate in the future. So there are more and more of them. We believe that for company growth today, faster isn't always better at first. In fact, we've seen these companies may take years to open the first 1 or 2 stores, and by the time they reach the 3rd, 5th, or 10th store, a lot of time may have passed. When they reach 100 stores, they might be able to open 100 more in just 1 year. Then when they go from 10,000 stores to another 10,000, it might only take a year as well. So now we actually prefer these companies that aren't the fastest, but rather those that know how to subtract, that are very disciplined. They make sure their products are precisely positioned and competitive, and they manage every aspect of the process. They refine everything to achieve maximum efficiency. Even though their current scale may not be large, they actually already possess tremendous potential.
Oh, okay. Hey, Mr. Chang, after listening to you so far, I feel like your understanding of efficiency and supply chain is really, really deep, because just now we were actually talking about how consumer demand is really diverse, right? For example, especially now, there are a lot of popular companies like Mart, which is more about emotional consumption, or Laopu, which is more about luxury brand premium. Do you ever feel like, hey, there are some logics that I now realize I might have missed? Or to go a step further, do you feel regretful about these missed opportunities? Do you think you can make up for them? Or do you just think, forget it, let's just focus on what we're good at?
Let me start with something. Buffett definitely talked about this. It's called the circle of competence.
Right.
Each of us, well, the things we can truly understand are definitely limited. So we have to find a way to work in the field we're best at. But still, coming back to it, historically, we probably did have a pretty deep understanding of efficiency, especially on the supply side. That might have been one of our differentiators. But in the past couple of years, looking at Mart and similar companies that tap into emotional aspects, we've also been learning. Because at the core, it's about differentiated pricing power, which is a very important factor in consumer investing today. I believe this is something that can be learned as well. And it can be incorporated as well, and we've seen this in the past. With this capability, I can create a standalone business model like this. For example, Miniso used to emphasize efficiency, but in the past couple of years, after adding emotional elements and IP, it has also upgraded its business model.
Are you talking about the top 10 business?
Its basic products have also become more attractive, and its overall gross margin has increased by about 10 percentage points. Wow.
This change has quietly taken place.
It's happening as well, right? In fact, even when we're making cost-effective products, we can absolutely introduce these elements to make our products more appealing to consumers.
That is, my products make consumers like them more, feel happier, and willing to pay me more?
That's right. It's just that today, when we communicate or tell these stories, we think, oh, it's all about emotions and being good at creating IP. But I believe that today, for companies that have truly reached this level, the founders are absolutely very, very well-rounded. And everyone will definitely come back to Porter's concepts. One is called the low-cost strategy, and the other is called the differentiation strategy. On the contrary, what we see in China's most competitive markets is that the best path for many is to start with a low-cost strategy, but ultimately transform into something else. Using differentiation to achieve premium pricing for products. In this regard, I think, for example, take BYD, right? At first, you might remember how Musk commented on BYD cars back then. He said, can you even call that an electric car? We don't even want to look at it, right? But in the past couple of years, BYD has been improving the quality of its cars, especially the core battery and driving experience. But now, when they can launch something like the Yangwang, right? A car that can move sideways, we joke that all it needs is a cannon to be a tank, right? And look at Xiaomi, which has launched so many mid to high-end products in the past couple of years. Back in the day, Xiaomi was also seen as just a basic model. But in the past 2 years, we've also managed to make it more appealing with more premium tendencies, right? Today, when we see Xiaomi's car come out, why do people buy it? It's for the emotional value. Not only does it offer great value for money today, but it also delivers emotional value that everyone can see and feel. You can even get the thrill of driving a Porsche, right?
Ultimately, it all comes back to Porter's theory.
Yes, what we're saying today is that in the end, there really aren't any fixed tracks in consumer investment. What truly matters is each company's most unique solution and positioning. Right? When we talk about 5 or 6 cups of milk tea, when we mention Mixue, Bingcheng, Gumin, and Bawang Chaji, are we talking about the same thing?
They each have their own distinct characteristics.
Exactly, because today, even within 2 or 3 different positioning categories, their products can all be excellent.
Their strategies are different.
Yes, that's right. I believe that consumer investment ultimately comes down to choosing truly outstanding companies, not just focusing on sectors or trends. Hot topics are only temporary. In the end, it's about who wins. In the past few years, we've been influenced more by external factors. Everyone placed more emphasis on those and overlooked some of our internal core factors. But in the past 2 years, it's been the opposite. The business environment has become more challenging and there isn't as much capital available to provide financial support. I actually think this is a good thing because only now are the real entrepreneurs and true professionals in this field starting to realize this. They're beginning to understand the truly critical factors and develop the necessary capabilities. In other words, it's only in the past few years that we've really started to get down to work.
I think following the logic you just mentioned, China will likely see a wave of consumer companies being weeded out in the near future.
Right now, everyone is still focused on how many companies are growing rapidly or on things like small home appliances and robot vacuums. But people may not have truly realized, actually, some time ago, I had the chance to visit Midea and TCL. In recent years, these companies probably haven't been in the mainstream spotlight, right? All of them now have annual sales exceeding 300 billion yuan. Nearly half of their revenue comes from overseas. Today, many of their production processes have been fully automated with robots. Their use of robotic arms in manufacturing has created extremely high barriers to entry. They've all become world-class companies. In fact, there's a group of companies that have been quietly honing their capabilities. When they finally step into the spotlight like Mixue did, by the time you notice them, you simply can't catch up anymore. There are actually many more such companies in China, and these entrepreneurs are extremely low-key, constantly iterating and improving. I think these are exactly the kinds of companies we most look forward to learning from and collaborating with today.
That's where the real investment opportunities lie, not in the places that are already bustling with excitement. For example, I remember when Mart had just gone public, we happened to have a chance to interview Li Lu, who is a student of Munger. We brought up the fact that, hey, with Mart's IPO, Sequoia made 30 times their investment. I asked him, what do you think about opportunities like this? He got really animated at that moment. He seemed a bit annoyed, maybe because he thought that kind of thinking was a bit short-sighted.
Right? Because it's simple, really. They're students of Buffett and Munger, and at their core, they look for companies in stable industries that can deliver long-term, sustainable, and improving economics. In other words, even a company as outstanding as Mart, from the perspective of investors like him, I still wouldn't include it in my consideration because it's still too early, right? Because in value investing, because his mentors, Buffett and Munger, would ask Li Lu, can you tell me what this company's revenue and profit margin will be in 5 years? If you can answer that with a high degree of certainty, then
I think there's a lot of uncertainty.
exactly. So if you can't answer that question, he might say, then let's just set it aside for now.
So actually, the topic we were just discussing was about your own evolution. Have you learned anything from your peers, for example, in terms of investment style or cases that are very different from yours? For instance, take Black Ant as an example. I feel like their investment approach starting from Mart and Laopu Gold seems quite different from yours.
Actually, we learn from a lot of people in the market. In fact, you and I have talked about this before. We discussed the issue of meaning versus efficiency. At the time, I felt I leaned more toward efficiency, but they had a really good understanding of the importance of meaning, right? So that's why they can invest in companies like that. We also started to learn from them, and in the past couple of years, you can see they've also gotten involved. For example, Linxi Henmang and similar companies are actually learning about efficiency as well. I think there are still many paths in the consumer sector today, you know. We need to learn how to discover these founders at an even earlier stage. A couple of days ago, I was reading Maigang and Dutuzhen and what they wrote about how to view things from the very beginning. For us, these are all entirely new inputs and topics. In later stages, like what Mr. Song Xiangqian talked about, how to help companies improve their management and how to plan for value creation, these are also important. I think that in today's consumer sector, in such a massive industry, each of us is really like a blind person feeling an elephant. It means that in the past period, everyone has really only been working within their own very small circle of competence. Being able to continuously gain insights and keep applying them in this area is already truly remarkable. Yes, in this process, of course, we need to constantly observe how others learn. And in this process, as we just mentioned, in this era, there are actually 2 or even 3 generations of founders competing on the same stage, right? Take beverages, for example. Within this sector, you have the original supply chain players. For example, from the very beginning, I could learn from Mr. Zhong, who is a master of major products. Today, I put this bottle of natural water here. 10 years ago, I would have bet on Oriental mathematics. There are also product-driven people, and there are channel companies, right? In this field, some can leverage channels like Dongpeng did, learning from others to create a single product similar to Red Bull, but I can leverage the channels. Distribution, marketing, and reaching the consumer, that's what I can achieve. To reach the top level and get to this point, there might be brands like Genki Forest that say, I can create products based on consumer insights, like 0 sugar and 0 calories. For example, with Gozishu, a company we invested in, you can see that, hey, you guys, Oriental Leaf is a truly remarkable product. Its pure tea offers the fragrance of tea, but the problem is that it can be bitter. However, for young women today, we don't want that bitterness.
We want it to be just a little bit sweet.
We want a subtle sweetness, and I achieve that sweetness by combining floral and tea aromas. Now today, you make the tall, slender bottle, and I want to make the square one. I can also create an excellent product. The product lineup launched by Guozi Shule has also grown rapidly in the unsweetened tea market over the past few years. So today I can see for myself that there is no single product or strategy that can win over everyone. On the contrary, the market is actually highly differentiable and segmentable. What's more important is whether you can gain insight into this niche market. Can you accurately identify this demand? Launch a very high-quality product, then use the 4P combination and ultimately achieve your goals After that, you can expand your capabilities. So today, in this era of stock competition, when the infrastructure is already in place, we find that it's actually harder now to expect to build a company worth 10 billion or 5 billion all at once compared to before. However, if I get the product right today, reaching 500 million or 1 billion with a single product is achievable. It's definitely much easier now to achieve this with a single product than it was a few years ago.
From the time you started the company until now, have you ever experienced moments when your emotions fluctuated a lot?
I think what I felt more was confusion.
Confusion?
I think confusion, for example, when we first started doing this, we made some choices that were different from others. As I mentioned earlier, when the entire market was betting hundreds of billions on offline and online retail channels, we chose offline. When everyone was pursuing innovation or focusing on the demand side, on the supply side, actually at that time, it was indeed during the process. We would also ask ourselves, why do we think differently from everyone else? Yeah, that's the confusion. Let me give you the example of geodogen rice. Some people might say, oh, I think things like self-heating pots, this kind of cereal or yogurt are more impressive. But why do we think differently? Yeah, it's confusing too. Why are people willing to invest 5 to 10 billion RMB into these front warehouses, burning through all that money just to reach 10 billion in sales? While on the other hand, someone else also achieves 10 billion in sales, but may have only received 300 million. They managed to reach this scale with just 500 million RMB, but still no one is willing to invest. That's where the confusion lies. Especially later on, when everyone saw a lot of this happening, I was actually extremely confused about those valuations for a while. At that point, our team would often say, look, this is what the top players are like today. These are the kinds of projects out there. We could only feel confused. You might ask, do we have to make some compromises as well? But looking back today, we really haven't received much positive feedback from this, right? For example, when it reached the whole market, and then in 2022 and 2023, at that point, everyone was gone again. Take LPs, for example. Everyone else told us that Chinese consumer markets aren't working. They've all stopped investing. So why are you guys still doing it? So I was also very confused, right? Things aren't working out for them, but for us, it still seems okay. They think it's hopeless, but we still see opportunities. Or maybe there are opportunities today. Among all these companies, when people run into problems, many of our colleagues don't really have any solutions either. So today we're also quite confused, and at every point, we might have our own biases. We have a slightly firmer belief, but we don't have certainty. We're just as confused as anyone else at any given time. For example, looking back, is it still possible to invest in consumer markets with US dollars? Are RMB funds really truly suitable for investing in consumer markets? In our industry, will these founders still be willing to take our kind of money? Our money. The way we build relationships with them, these founders who aren't short of money, I think all of this is just confusion on our side. We don't have the answers. There are no definite answers, right? All you can do in this process is to keep feeling your way through it, keep exploring, and keep moving forward.
Speaking of confusion, I wonder if you have any definite predictions about the future of the consumer market.
Looking ahead to the next 10 to 20 years, we believe that China's consumer market will undergo more fundamental and structural changes, and that this period is just beginning.
How should we understand these fundamental and structural changes?
The three main core factors. First, we are moving from incremental growth to stock competition. At this point, a lot of the ways of playing the game need to change. Second, in the past, most of our solutions came from the seller's side, that is, driven by brands and supply. That's how our supermarkets and everything else used to operate. But today, it's certain that everyone is moving into an era of buyer-driven solutions. Whether it's product development or retail, you'll notice that everything now has to be approached from the consumer's perspective. To solve this problem, buyer-driven solutions are now a certainty. In the past decade, we were indeed driven primarily by online channels. That is, online was squeezing out offline. But starting from the past couple of years, I think the best era for offline has already begun for offline channels. These changes are once again leading the way in retail technology, and they're integrating online and offline together to create new business formats. This approach is just beginning.
There's also a small question. Do you think AI will have a significant impact on the consumer industry, or is it actually not that closely related to consumption?
When it comes to development, do you want AI to develop pharmaceuticals or to develop consumer products today? Which do you think AI is more capable of? The efficiency would be a bit higher. From my own perspective, I think it's probably easier for AI to bring changes to pharmaceuticals because drug research and development is largely about determining combinations with certainty. Even if I develop something, I can qualitatively say that my drug is 15% more effective than before. But if Mixue Bingcheng develops a new product today and claims this lemonade is 15% better than the previous one, can you really be sure?
It's hard to say because there are just too many consumers involved.
Yeah.
It's also very hard to collect their feedback.
To solve the final problem, I have to address the 4 Ps, right? Today I have the product, the price, the place for distribution, the supply chain, and also brand awareness. The chain here is just too long. When we say you can't copy Haidilao, is it really because you can't replicate the taste of their hot pot? What you really can't replicate is how they select and train blue-collar staff at the grassroots level in their restaurants, how they get them to follow the rules, genuinely motivate them from the heart, and enable them to deliver a wonderful experience to customers. Any restaurant company that can achieve this is basically a training school.
This is something AI can't do. When it comes to products, you need to do consumer insights, and consumers are people. How can AI connect with people? That's a big question, right? Okay, so now we're in this overtime session, and the question is, I think it might be related to this. This actually doesn't have much to do with the previous wave of new consumer investments, but it is a very hot topic right now. Could you give us some comments? The instant retail war is in full swing. What's your take on it? What are the most critical factors or key indicators in this battle? Are there any decisive moves or turning points in this?
Of course, there are barriers. The main one is efficiency. Essentially, when we talk about a single delivery rider, why do we use division? It's about how many orders a single delivery rider can handle for you each day and whether the commission everyone ends up with is enough to make a living. If that's the case, then you can expand, right? Of course, especially if you take away all the current subsidies and you can still make a living from this business, then I can stay in this market. So has the world changed today? Has the structure changed? Why is JD.com? JD.com's entry into the food delivery market was also somewhat beyond expectations, wasn't it?
Very much so.
Exceeding expectations can give you a temporary lead. I can enjoy a certain lead, but that doesn't mean the issue has been perfectly solved, nor does it mean your position is unshakable, right? Yes, Buffett talked about this, especially when discussing retail businesses. Some businesses are really smart ones. You only need to be smart once. You may have really solved it once, but in retail, you have to be smart every day in the future. That's just too hard, right? So today in retail, none of these bosses really have it easy. There's no way you can just step away from the front lines and say your position is secure forever.
Yes, I actually think the consumer market is especially worth looking forward to because I often tell the authors who write about consumer topics that consumption is an industry you can keep writing about forever. It's not like a trend that comes and goes in a couple of years. There's another small issue. I feel like consumer goods companies, or actually not just consumer goods companies, but also investment institutions, are quite obsessed with the idea of young people. Maybe because young people represent change and new consumption opportunities. So I wonder, are you obsessed with young people? Or do you think there's no need to be overly fixated on them? Because, for example, with many basic consumer goods like rice, it doesn't really seem necessary to study young people.
Because if you understand young people, what can you do? You can create what we call discretionary, variable, and innovative products, right? And also with young people, you can use many differentiated angles to study them. So when we say we study young people, essentially it's because we want to invest in these kinds of companies. And these companies, as we just mentioned, might be placed in. At a certain stage in the capital market, this is exactly the most sought after area, right? Isn't it? So this forms a cycle for everyone. Today, people have already noticed these subtle trends. When young people start to lead and everyone begins to like Labubu and the whole world is chasing after a pop mart that's worth 3 times as much as Kering Group, that really does have a powerful allure. But today, with the locust tree returning, there are so many businesses we can do in this world, and I can still transform myself. I can do things for the long term. I can do things to become stronger, right?
The key is to understand young people. If you don't, there's no need to be overly formal. If you go too crazy, in the end, even in the primary market, the investment returns might just not add up. All right, I think today we've actually taken a broad look spanning 8 or 9 years and discussed a big topic. I hope that in the future, when we get into more specific topics, we can invite you back as a guest.
Sure.
Great.
Thank you. It was a very enjoyable conversation.